Now we're going to talk about futures. The origins of futures contracts go back to Greek and Roman times, where forward contracts for wheat and also the Japanese rice market in the 18th century. So there's records of these forward contracts, and more organized futures markets grew during the 19th century, especially for the grain market in Chicago. So farmers could sell their wheat at a price fixed today, and bakers could buy their wheat at a price fixed today. So the contract could be exchanged in April, but the actual wheat didn't exchange hands until September, when the grain market or the harvest came in. Now, the difference between futures and forwards is that futures are traded on exchanges, as we saw in our first video of this topic. And there are specific contract maturity dates. So, for example, there may be maturities every month or every 3 months. Most futures contracts are on a quarterly cycle, but you also get the 3 near-term months. So at the moment, you'd be able to trade futures. Where are we now? We're in November. You would have a November futures, a December and a January. And then depending on the quarterly cycle, if it's the March quarterly cycle, then you'd also have March, June, September, and that would be what you'd have, because you've already got, you wouldn't, well, you might even have the following December. You can have contracts going more than a year. In oil markets, they go up to about 2 years futures. So the idea of a futures initially is that it provides a hedge against the risk of price fluctuations. And we'll go through that in the next slide. So at the time of the exchange of the contract, the buyer and seller just agree on a price at the maturity of the contract. So they have a piece of paper where they agree on a price. There's no exchange of physical or anything like that, at least at the time of the buying and selling of the futures. Now, the largest futures exchanges are the Chicago Mercantile Exchange and the Chicago Board Option Exchange. They also trade options, both of them. And the reason is because of the development historically in the 19th century of the grain markets in Chicago. So they are the largest exchanges in the world. The CBOE did try Bitcoin futures, but the CME one was much more successful. And so the CBOE withdrew their Bitcoin completely. So CME is the only regulated futures market to actually trade Bitcoin. BARC tried, that's the Intercontinental Exchange. It's a big derivatives exchange, mainly in Europe, but the CME have ousted them from that as well. So the CME is where the secondary market is, and as well as that, there are all these unregulated futures exchanges, which I'm going to talk about today. And on those exchanges, there's a lot of speculation. But before we get on to speculation, let's talk about hedging, the primary use of futures. So a consumer or somebody seeking to buy the spot in the future can remove any risk from the price I pay in the future by buying a futures contract now. So suppose I am the baker and I need to buy grain in the future. It's now April, but I need to buy grain in September. I can't buy it now. Maybe there isn't any grain to buy now, or maybe I don't want to buy it now. Well, how would I store it? Maybe it will go off. So I don't want to buy the spot now. I want to buy on the spot market, but not now, in the future. So what I'm going to do is to lock in my price risk. I'm going to buy a futures contract at a price agreed now. So that piece of paper, that futures contract, will be redeemed in September, and I can either make or lose money on that contract. So I buy the futures now, and if the price of the futures goes up, I can sell it at any point. I don't have to wait until expiry. But if I waited until expiry, I'd look at the time at expiry, and the difference in price would be a profit or a loss. But if both prices rise, so I make a profit on the hedge, on the futures contract, I have to pay more in the spot market because the spot price has gone up as well. You see, the futures and the spot prices are kept very close together by something called arbitrage. We'll get onto that in a minute. And so I know that if the futures price changes, so does the spot price. They're very, very highly correlated. And similarly for a producer, the other side of my contract is a farmer who wants to sell his grain now and to take away all the price risk in the future. But in fact, what's going to happen is that the farmer will go to the grain market with his physical grain and sell it on the spot market. But having that futures contract takes away all the price risk. So if both the prices rise and I've sold a futures contract, then I lose money. But I'm going to make money because I don't have to pay so much in the spot market. So if they rise, I get more in the spot market for when I sell the grain. And in the words in brackets work as well, as you read them, if you substitute the words in brackets. So who are the consumers and producers in Bitcoin? Well, the consumers are the people who, well, in Ether anyway, they are the people that need Ether for smart contracts. We've seen that there's quite a shortage of Ether. There's a real run on Ether. One of the reasons why the Uniswap exchange has got so much volume is that people need to swap into Ether to try to fund their smart contracts. Or if the Ethereum blockchain gets clogged up, which it has done, then they want to switch from their Ether holding to, say, EOS and use the EOS blockchain or the Polkadot. So you'll see a lot of swaps between the tokens that are for DeFi, for smart contracts, DeFi is the craze at the moment, but it could be, next year it's something else. But at the moment it's DeFi contracts that everybody's trying to put on to Ethereum or EOS or elsewhere. So those are the consumers. The producers are the people who get Bitcoin or Ether through mining or validation. So a big mining pool actually knows they're going to bring a lot of Bitcoin or Ether to market in future. They're doing it all the time. They know because their hash rate tells them that their likelihood of winning the proof of work or the likelihood of getting money through proof of stake is pretty well modeled. So they know that in future, for example, now with the Bitcoin bull run going on, it's probably a good idea for these people to sell futures, knowing that 3 months from now, Bitcoin price probably gone down. Or it could be that they actually think the price is going to go up, in which case they're not going to hedge. But I would imagine that quite a lot of the trades on futures contracts right now with this bull run will be producers selling the Bitcoin futures. Now let's look at margin trading in more detail. So a CME Bitcoin futures is 5 Bitcoin, which at current prices is about $90,000. So I don't need $90,000 to buy that piece of paper. I just need whatever the futures contract value is with the leverage. So for example, it could be 10 times leverage. So if the Bitcoin futures is 17,000 right now, then I would only actually pay 1,700. So that's the leverage. And so the margin would be 10% in that case. Now, this initial margin is one thing, and the maintenance margin is something else. And it doesn't have to be as large as the initial margin. So say the initial margin was 1,700 and I bought a Bitcoin futures for 17,000. Now, if the price fell to 16,000, my margin account would now be worth 1,700 minus 1,000. It would only be worth 700. And that might be below the maintenance margin. I might be asked for a margin call. So assuming the initial margin is, as it often is, the same as the maintenance margin, every 24 hours or so, the exchange would ask me to top up my margin account. So if I paid 1,700 and the price fell to 15,000 and it was originally 17,000, I've lost on paper, even though I've still got the futures contract, 2,000. And so I'm in negative margin, and I would definitely have a margin call then. And I'd need to top it up to whatever the maintenance margin is. On the other hand, if the price goes up by 500, then my margin account notionally has 2,300 in it. And given that you can get interest on that margin account, I don't know whether the unregulated exchanges do that, but standard exchanges do, then you may have interest as the prices rise. The thing about margin accounts on the regulated Bitcoin futures exchanges is that they're tiny. It's not just the futures exchanges, but all Bitcoin exchanges allow quite large margins. Well, all the unregulated ones. Things like Coinbase or Bitstamp, the largest spot exchanges, they don't allow margin trading. Now, I said I'd talk about arbitrage. So here's a little bit of maths. You probably see this equation before. The fair value of the futures, that's the star. I mean, the market value is whatever the market makers can sell their lemons for, you know, so that's the market price. But the fair value, the theoretical value, is just the accounted spot price today. And so this ST on the right of this equation is the spot price now. On the left of the equation is the futures price now, but only its fair value. Without the asterisk, it's the market price of the futures, which is very, very close, but not identical to the spot. There's always going to be a bit of a difference. But as little t approaches capital T, as the futures contract approaches expiry, then so does the price of the futures. And at the time of expiry of the futures, by definition, the settlement value for the futures contract is the spot price. So if I buy it at 17,000 and I hold it all the way to maturity, then I get the spot price at that time. And then I have to either financially settle or take physical delivery. But in Bitcoin, it's all just a financial settlement. So you'll have seen this standard arbitrage argument before in one of your finance courses, I'm sure. And this arbitrage keeps the market price very close to its fair value. In other words, what we call the basis risk. That's the difference between the spot and the futures. And the standard deviation of that difference is called the basis risk. Now, this ST on Bitcoin futures is not one price. And a lot of the unregulated exchanges, they actually also trade spot. And their spot price is what you get at expiry. But on the CME, they don't trade spot. So they've got a sort of weighted average, a volume weighted average price across Coinbase and Bitstamp and Gemini and 5 different exchanges. It's called their Bitcoin reference rate. So it's not a traded price, and this no arbitrage argument doesn't really apply unless you've got one traded price. So the basis risk can be quite big, actually. So speculation with futures. Futures contracts can also be used as a pure bet. And because of the leverage, because of your tiny margins, huge amounts can be won or lost. And you can see in the background here, this yellow jacket, the famous Barings yellow jacket. Well, this is way back. Nick Leeson, who was a rogue trader for Barings, he made the entire trading firm went bankrupt because he was trading copper futures, and he kept losing money, but he hid it in a special 999 margin account. So his margin account was going negative and negative and negative, but he hid it away. And eventually he kept doubling up his bet. So he was getting larger and larger positions, just like gambling on a casino. And the whole company went bankrupt because of, and he was put in jail for quite a long time. Nick Leeson was his name. So trading is very, very active on the futures markets, and their prices move much more rapidly than spot prices. And that means that price discovery, i.e., where is this common Bitcoin price, that there's always going to be a little bit of difference between different exchanges, something called exchange arbitrage. It's very difficult to do nowadays, but a year ago, you could hold Bitcoin on two exchanges and trade the price difference, buy on one and sell on the other, depending on the prices. That type of exchange arbitrage could be done until maybe 1 or 2 years ago. But now it's not possible. And it's quite clear that, and I'll show you this in the next video, the price discovery, the leadership in prices is coming from these unregulated futures exchanges. Here's a very recent, I got this a couple of days ago, about derivatives volume triples spot trading. That was a Coin Telegraph article, in case you want to have a look at it. So let's have a look at the notional amount. Obviously, it's not the actual money that's being bet, but it is the notional trading. About 5 times more in notional is trading on Bitcoin futures than Ether futures. We also saw that there's more trading on futures than there is on the spot markets. So this data is just for October this year. The skew highest volume was over 30 billion on Bitcoin futures on the 21st of October. And the same day, it was about 7 billion on Ether futures. But other than that, you can see the coloring is quite similar. So the same exchanges are dominating. Binance has been growing, but the gray one, Huobi, in October has been the main exchange particularly for Ether futures. Binance and Huobi. I think Binance has probably got more than Huobi on Bitcoin futures though. That's just in the volumes. Now we look at the open interest. So one futures contract is issued by the exchange. For example, it could be issued exactly 1 month before expiry. And that contract's changing hands all the time. But the open interest is how much Bitcoin is in that particular contract. Okay, and there could be, for example, on OKEx, you have the perpetual, you have the weekly futures, you might have 3 weekly or monthly futures. I mean, each exchange has got its own schedule for issuing futures. Most of them do have, very short-term futures, and some going up to 3 or 6 months ahead. But most of the trading will be on the short-term contracts. An exception is, for example, you have a quarterly one that's, for now, I could trade the June contract and the March contract. and the December contract, but still most of the trading will be on the November contract. But when that quarterly one, the December, moves closer to maturity than the very short, nearer maturity than, say, a 2-week contract, you might find there's more in that quarterly because it's been going for so long. It was issued a long time ago, and the 2-week contract was just issued. So anyway, that's enough about the trading volume. The open interest, though, we know we can more or less schedule that, and you can see that this is in $1 billion. There's about 1 billion open interest on OKEX, on Bitcoin futures, and about 0.81 billion open interest on Binance. And when it comes to the volume, though, this is over the last 24 hours, 4.72 billion notional changed hands in terms of the volume trading. So, and OKEX was not the biggest, although it's got the most open interest. It didn't have so much active trading because only 2.65. So I made a little table here. OKEX had open interest of 1. The average trading volume, that was for 24 hours, was 2.65. So I can look at what I call the average holding period, which is the open interest divided by, well, half the trading volume, because we double it, for every buyer and seller, we count a trading volume of 2. So we divide that by 2, and that gives me an average holding period of 0.75, 3/4 of a day. And I can do it for all the others as well. This is on Ether. Let's have a look at Bitcoin here, where CME, for example, they have Bitcoin futures. And a contract on CME is held on average for 5.5 days, whereas on Binance or Huobi, actually I was just looking at OKEX recently, and that's come right down as well. On average, at the moment, there's so much more volume being traded that it's come down to about 1/3 of a day on OKEX. But still, it's much, much longer than S&P 500, which is only a few hours. Okay, so much less overall on Ether, but you see the same features. Binance and Huobi has the most speculative trades. Deribit the least. Finally, what I talked about with price manipulation strategies, spoofing and so forth. This is very common close to maturity. It's called painting the tape. So here's a picture that somebody put up of painting the tape of S&P 500 futures. This is exactly what JP Morgan has been fined nearly $1 billion for on S&P 500 futures and on silver futures as well. And the CFTC have known this because they can see the identities of the traders. I can't do that with the data that I have, but I can certainly see a pattern. And it's quite clear that some people had they were long futures and they needed to, they wanted to hold them. They didn't want to sell them. And so they spoofed up the price, which we can see happening in order books all the time. And another way of manipulating the CME futures price is to actually manipulate the volume weighted average price, the VWAP price itself. So, for example, in April 2019, that was a maturity date for the CME futures. 100 million USD was dumped on Coinbase, Bitstamp and Kraken to depress the price of the futures. I wrote about that in a discussion paper with Daniel, which we left up on SSRN, even though we didn't publish it, which I think we did. Okay, so that's it for futures.